a 967 premium. Shanghai is paying 967 more for silver. That is 12.10% above Western price. That gap does not appear without stress. It has not happened without consequence. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver closes at 79.60 and the physical market is diverging fast. Let's get straight into it. Silver closes Friday at 79.60 per ounce. That is up 1.52% on the day. The weekend's roughly 4% higher. That is 4 consecutive weekly gains. The number looks clean, the structure is not. The Shanghai Gold Exchange prints 89.58 per ounce. That creates a 967 premium. That is 12.10% above Western spot at 79.91. The 6-month average premium sits at 950. The current level exceeds that average. This is not tax. This is not regulation. This is physical demand. The ones paying attention already know what that means. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX silver structure. 48,370 contracts remain open for May 2026. That represents 241.8 million ounces. First notice day sits roughly 9 business days away. COMEX registered inventory stands near 76 million ounces. That creates a 13.4% coverage ratio. Stress territory begins below 15%. That level is already breached. This follows multiple years of physical drawdown. Approximately 762 million ounces leave global stocks since 2021. The cumulative deficit from 2021 to 2024 exceeds 678 million ounces. The unusual detail is the timing. Open interest remains elevated into delivery. Inventory does not expand to meet it. The timing is what deserves scrutiny, not the event itself. The timing. Think about what that sequence actually means. Paper claims exceed available deliverable supply by multiples. Most contracts roll. Some do not. What happens if that percentage shifts? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time inventories approached stress levels, price volatility accelerated sharply. The data is already telling you something. Let's build it out. Now let's build the full picture because COMEX structure does not exist in a vacuum. The World Silver Survey 2026 has dropped. The Silver Institute and Metals Focus confirm a 6th consecutive deficit year. The projected 2026 deficit stands at 46.3 million ounces. That is a 15% increase from 2025. Industrial demand declines 3% year over year. Coin and bar demand rises 18%. That shift matters. Demand composition changes. Supply does not respond fast enough. The rate of inventory draw is not slowing. It is compounding. The data is doing the talking. Shanghai premiums remain above 6-month averages. COMEX coverage remains below stress thresholds. Global stockpiles continue declining. The ones who were dismissed for saying physical matters, they are not saying much right now. That is not coincidence. That is a pattern. And here is what makes that picture even harder to ignore. Registered inventory sits near 76 million ounces. Open interest represents 241.8 million ounces. That is more than 3 times coverage. At the same time, most contracts historically cash settle. That creates the tension. That is not a contradiction. That is the setup. And before anyone takes that as a green light, timing remains uncertain. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Sit with that. Here is the number most people are not talking about. A 12.10% premium in Shanghai. That is a real cost difference. That is real money paid for real metal. Now the macro, because this is no longer a backdrop, it is the primary variable. The US dollar index trades near 6-week lows. Federal Reserve policy remains cautious. Inflation expectations stay elevated. That reduces pressure for aggressive tightening. A weaker dollar supports silver pricing. That is mechanical. At the same time, geopolitical developments shift risk sentiment. Markets price easing conditions. Physical buyers do not wait. They act immediately. That creates divergence. Look at the Shanghai premium and tell me what probability you assign to tight supply. When markets start pricing the reality of sustained deficits, silver reprices higher. When dollar strength returns, silver reprices lower. That is the historical pattern. Every time physical demand diverges from paper pricing, it has not been different yet. The ones who verify do not argue about it. Silver Western spot at 79.60, Shanghai price at 89.58. That is a 967 premium. Short-term picture remains unstable. Key variable is May delivery behavior. If open interest rolls, pressure eases. If delivery demand increases, pressure builds. If dollar remains weak, upside continues. If dollar strengthens, downside follows. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Volatility remains elevated. Event risk remains high. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Industrial demand declines 3% year over year. ETP outflows continue from January 2026 peaks. A stronger dollar pressures commodity pricing. The bull case is equally real. Shanghai premium sits at 12.10%. COMEX coverage ratio stands at 13.4%. 6 consecutive annual deficits are confirmed. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. Structural pressure is already built into this market. The only question is when it resolves. Don't take my word for it. Verify every number I gave you today. Check the data yourself. COMEX data reports, Shanghai Gold Exchange data, the Silver Institute reports, logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.